Good morning, ladies and gentlemen. I would like to thank Philmaze for giving me this opportunity to come and share our experiences in commodity collateral financing in India, and also to learn from this August gathering in this very important seminar and workshop. Uh, as an organization, Arya is the largest agri warehousing player in India, and it specializes in working in smaller primary and secondary rural agriculture markets in the country, thereby extending the last mile for post harvest agriculture in the rural hinterlands of India and unfolding opportunities that are otherwise available to larger players in bigger agriculture centers in the country. As an organization, we work as a post harvest value chain integrator, bringing together a integrated suite of services starting from aggregation of produce for FPOs that we do for on behalf of their members. We also provide warehousing services closer to the farm gate. We ensure that financial linkages are enabled for the smallholder farmers and their organizations at locations which are closer to where they are. We, as part of that process, we work with multiple banks where we act as collateral managers, as third party associates who ensure and certify the quality and quantity of produce against which banks extend commodity collateral financing to various entities. We also have our own financing arm to service locations where banks do not provide finance and to service those customers who are beyond the ambit of formal bank finance. We also provide market linkages for entities that store in our warehouses because we believe that storage, finance, and linkages to buyers and markets are they form a complete offering without which post-harvest architecture is incomplete. And uh, in this journey, Arya is today the largest agri warehousing player with the largest pool of near farm warehouses in the country. We manage about 1,500 warehouses across about 21 regions in the country. And we have a total asset under management of close to about $1 billion spread across these 1,500 warehouses. We have been able to leverage technology to extend the last mile in post harvest agriculture. And this has been made possible because of various tech initiatives which have helped us service the small scale and small ticket requirements of smaller entities that operate in the primary and secondary rural markets of India. We use flexible hermetic storage solutions which require negligible capex to address the shortage of warehousing near the farm gate. We have an end to end agri warehousing and post harvest services platform, which enables users to identify warehouses closer to where they are. It describes each and every warehouse with respect to the physical parameters and the various facilities that are available in a particular warehouse. It also bundles services of finance, insurance, logistics, and market linkages on one digital platform. Today, we are the only digital warehousing platform in the country. We have about 3,000 warehouses with a total capacity of close to about 7 million tons that is listed on our platform. We use artificial intelligence to assess the quality of the produce. As I said, when you service smaller customers in smaller locations with much smaller lot sizes and ticket sizes, we need to be efficient and cannot be working only on a physical infrastructure. So we use artificial intelligence to assess the quality of the produce against which we issue warehouse receipts and also enable finance. We operate an assisted fintech platform, which is completely automated, where commodity collateralized loans are sanctioned in less than 5 minutes to customers on the basis of an automated credit decisioning engine, which is inbuilt into the fintech platform. And with a good combination of agri-tech and fintech models, we have been able to scale up quite drastically to become the largest agri warehousing player in the country today. I would be talking about commodity collateral financing as a tool for irreversible smallholder prosperity. This is a challenge that not only India, but all countries across the developing nations face. And we believe that in order to solve for the problems of smallholder farmers in the country, commodity collateralized financing is a very, very effective tool. If you were to look at any traditional commodity value chain, we find that closer to the harvest, the prices are the lowest and there is a glut in the market. Now, the farmers are forced to sell in distress because they do not have access to cash flows at that time. And there we find excessive exploitation of farmers. Similarly, it, all other stakeholders are also not immune to these realities. So, if you consider a processor, for example, which forms a very important part of the agriculture value chain, the processors would normally prefer to buy during the harvest season when the prices are lower, and they may want to buy and store the produce. But if effective financing tools are not available, they are forced to either procure only low quantities during the harvest season and purchase commodities at later stages at much higher costs, thereby increasing inefficiencies. Thus, it is extremely important to find a solution which helps farmers to store when the prices are low so that they don't sell at distress values and sell the produce when the prices actually move up and generate maximum returns. Similarly, for processors, they should be in a position to procure commodities when the prices are low, store and use it throughout the processing season or throughout the rest of the year. And one of the core solutions which enables and addresses these issues for farmers, for traders, for processors, and all stakeholders involved in post harvest agriculture is collateralized commodity financing. The farmer can store the produce and avail of finance to meet the cash flow requirements without getting into a debt trap and avoiding distress sale. A trader can store at the time of harvest and sell it at a later time when the prices appreciate. Similarly, a processor could procure more raw material closer to harvest and use it throughout the rest of the year. And this product also provides and offers a great amount of comfort to the lending institution, a bank, a non banking financial organization, whichever entity extends finance against commodity as a collateral is actually shifting credit risk to commodity risk, which is much more defined. And liquidation of commodities is much simpler as compared to any other risk mitigation mechanism. And it is from this background that we say that collateralized commodity financing is a very, very effective tool. Now, if you were to look at the Philippines market, uh, we've just taken two commodities where we feel there is a significant possibility of rolling out collateralized commodity financing. Uh, be it rice or corn. If you look at from the period of around September to November, December, and in case of rice, maybe up to January, the prices are at the low because these are the main harvesting seasons for the crop. And if you see the prices of corn around August and September to the prices of corn in the month of February or March, there is a clear upside of about 12 to 13% in a matter of 4 to 5 months. which means an annualized increase of about 25% or more. Similarly, if you were to look at rice as a commodity, the prices during the peak harvest season, which is towards October, November, and December, and the, the prices during the off season, which is around June, July, we find a similar temporal arbitrage which exists. And hence, if there is a product, if there is a mechanism to help farmers and other entities to store the produce closer to harvest, that could enable an increase of about 25% on an annualized basis. So this particular product is as a very, very effective tool which can be used to alleviate the concerns of small farmers and their organizations. In India, we disburse more than about 9 to 10 billion dollars every year against commodities. And this is a product which can address the needs of farmers who have nothing else but their own produce to offer as security to lenders. In India, the operating model operates between a lender, which is a bank, and a borrower, which could be a farmer organization, or a processor, with the comfort of a third party agency, which is called the Collateral Management Agency. Now, this agency is a third party agency that certifies the quality and quantity of produce which is offered as collateral to the bank, and takes the produce in its own custody so that the bank has the required assurance to extend loans to borrowers. And this model works beautifully because it ensures that the bank takes a commodity risk, which is in the possession of a collateral management agency that acts as a third party agent on behalf of the bank to manage the collateral. And these loans being absolutely secured and fully secured ensures that the interest rates that are offered to borrowers are much cheaper than any other form of finance. We have also seen this instrument being extremely useful for organizations of smallholder farmers. Now, in this illustration that we show, farmer organizations could procure the produce of their farmer members, store it in a warehouse closer to where they are, and the farmer organization could avail of a loan against the produce. Now, when the producer organization procures the commodity from the farmers, it insulates the farmers from any price risk. And subsequently, when the producer organization actually goes ahead and sells the produce to a commodity buyer, to a corporate, to a processor, the price rise comes to the producer organization as profit, which can then be distributed amongst its members as dividend. And this is a very, very effective mechanism to manage the risks for smallholder farmers while ensuring that their cash flows are maintained and the upside on the commodity value is available to them on a real time basis. Now, having said that, we believe that collateralized commodity financing is a tool which can transform agriculture value chains to the benefit of smallholders, their organizations, and other smaller players in the ecosystem. The product ensures that there is development of a robust storage infrastructure in the ecosystem. It ensures that the post-harvest losses, which I'm told currently in Philippines is in excess of about 15%, is controlled to a very large extent. It also helps prevent distress sales and losses for farmers by leveraging on the temporal price arbitrage which is available in the commodities. And we've seen that for corn and for rice, so far as Philippines is concerned. And similarly, it also builds a robust and a secure mechanism to ensure access to finance for smaller entities who are otherwise excluded from financial inclusion. And with this, I would like to stop my presentation and I would be open to questions. This is in brief what I wanted to share with you in terms of the concept of commodity collateralized financing and the ability of this particular tool to alleviate the concerns of smallholder farmers, their organizations, and other small players in Philippines and in similar countries. Thank you.